A lot of times, the highest yielding pools on Aerodrome aren't always the easiest to scale or even the best for your portfolio. Because in DeFi, the real question is not what pays the most. The real question is what survives long enough to matter and will provide yield without destroying your portfolio with impermanent loss. And this truly matters right now because people are still choosing LPs the wrong way. They see a big APR, they see those high emissions, those narrow ranges, and they see that nice dashboard and they just scale into the position like an ape, believing it'll look profitable on day one. But guess what? The chart breaks down and they suffer serious and permanent loss. That is how people donate to the market makers and to the traders when they think they're farming good yield for themselves. Hi, I'm Kevin, and this is Dad's DeFi Space. And in this video, I'm going to give you a real update on some of the best Aerodrome pools I've decided to scale into, how I choose them, and how I think about LP management in the base ecosystem right now. I'm also going to walk you through some pieces of the framework I use to research these pools. And if you want to dive into this in more detail, check out our first Aerodrome video on our channel. So this video is about three of my favorite pools. It's also about my process, my positioning, and the risk I'm taking. If you like truthful content like this, please like and subscribe. It is highly appreciated and helps with the algorithm and to get my content out to more who want to learn about crypto and DeFi. Now, in the short term, still believe LP selection, just like our DeFi lending and trading or perps, whatever you're into in this space, has to be defensive and intentional right now. It is a bear market. I do not want to just scale because the APR is high. I want liquidity that's actually being used. I want pairs that people genuinely trade, and I want assets that I truly believe in. So if I do get converted into one of the assets, I'm okay with holding that for the long haul. I also want setups that I can manage without pretending I'll perfectly time each rebalance. Although one of these positions I'm going to share a little bit later in the video is a automated position by Aerodrome. Now, in the midterm, I think Aerodrome remains one of the most important places to study and provide liquidity on the base blockchain. That's because there's a huge amount of routing, liquidity, and incentive competition on the Aerodrome platform. Aerodrome is still the central leading venue for liquidity on the base blockchain, rivaling Uniswap, who we all have heard of, and their slipstream concentrated liquidity positions has extremely meaningful volume behind it if you check out DeFi Llama. Now, this does not mean that every pool is great or good or even decent, but it does mean the protocol matters enough to consider locking some of our value into one of their slipstream positions. Now, again, right now, my macro view has not changed at all. Still believe structure over emotion and processes over predictions. I truly believe this is even more important in DeFi, especially with LP, because Ps definitely punish sloppy thinking faster than any other form of investing in this space, unless you're playing in the meme trenches and getting rug pulled every other day. Just remember, a bad spot bag can sit in your pocket, but a bad LP can bleed from multiple directions at the same time. Now, let's talk a little bit about Aerodrome and why it matters in the first place. Aerodrome's not just another DEX with a token attached to it. It's a major liquidity marketplace on Base. And the reason that matters is super simple. This is where liquidity sits on Base. The activity is following. And when activity and trading follows, you got fees, incentives, and concentration allows us to truly amplify that yield. Now, Aerodrome is not just about swaps, it's also a game of liquidity, the emissions, gauging votes, and positioning. The protocol runs on weekly epochs and vote directed emissions and incentives offered by token and pool creators. Now, the gauges distribute emissions to the LP depositors, which means your LP return is not just about trading and the fees, it's also whether the people and the market continue to care about the pool you're providing liquidity with. That changes everything because now you're not only asking, is this pool truly paying well? You're asking, why is the pool paying well? Is it truly durable? And what happens when those votes move away? Will the fees still make up for it? Maybe not. A lot of times you see those admissions move to somewhere else, and then that yield from that pool dies out, and you're left with a big bag of impermanent loss. Now, we are sitting at my Aerodrome position dashboard. But before I actually discuss any of my positions, let's talk about the research framework I actually use. And this is the important part that most people in this space skip. When I truly research Aerodrome LPs, I never start with APR. I always start with the asset. Do I believe in it? The next question I ask myself is, do I actually these tokens for the long haul? Because if you want to hold the tokens, you should if you or excuse me, to hold those tokens, you probably shouldn't be LPing it. That sounds obvious, but many people ignore this all the time and they get distracted by high numbers. They start chasing yield on assets they truly don't believe in, and they act surprised when the emissions are not enough to offset that impermanent loss damage. Now, is there a real reason for traders to use this pool? Is the next question I ask myself is there real demand? Actually, is there an actual reason for traders to use the pool? And not theoretical demand. I mean, right, things can get hot for a little bit. We've all seen pumps and dumps, but I don't mean staying hot just for a little bit. I mean actual the majors and stables and important ecosystem routes, right? And you'll see that when we look at our full little portfolio and what positions we selected. The third thing I look at is total value lock because if the TVL is very small and the APY is insane, that could be a rug pull and someone could pull the liquidity and then you can't even withdraw your own liquidity without suffering slippage. Don't worry about that now, but we have slippage and plenty of our other videos. And remember, a pool can show that APY and it's showing that because capital is thin, or it's a concentrated position and everyone else's liquidity is out of range. Although I do like to snipe those on occasion. In fact, that would be a really awesome DeFi bot or AI agent to build that could snipe liquidities out of range and get some very dense APY for short amounts of time. After staking this Solana position, you can see that right now we think we're earning approximately a 251% APR. I have a range between 77.62 cents and $93.02, which right now I'm feeling pretty comfortable about until again the next leg down. If we have another pump, I don't think we're going to go much higher than that. So I'm happy with that range on Solana. So we're going to stay in this position for a little while since we just staked it or you haven't earned much admissions yet. But we will probably scale up this position, keeping it similar in size to this one right here, and then keeping the Coinbase USDC one as our core position with a lot more capital. So these would be my second bucket, mid-tier risk positions. But again, I like this category more than I like just random ecosystem pairs because you're using the majors. These are your blue chips. So they're still very, as far as LP and conservative choices for your assets. Now, do understand, even with your core positions, you're going to have certain risks for Coinbase, Wrap Bitcoin, and USDC. Again, directional risk and permanent loss. You have exposure between the different assets. But Before we went into some of the more degen positions, I wanted to discuss one more. Now, this position has not been scaled, and we just opened it up today. It is a wrapped Bitcoin, Coinbase Bitcoin position. It's earning a really high APR right now, around 155%. We have not staked it yet because I'm kind of debating if I want to add more capital to it. But as we make profits in the other position, and as the bear market continues, that next down that we believe we're going to get, I'm going to start scaling into this correlated pair of wrapped Coinbase Bitcoin to get more capital appreciation, as I believe the market may go back up at the beginning of the next bull, because this position and my other core position will be ones that we will hold on to for a long time. Now, for this is set perfectly for someone who wants major asset exposure, but you prefer those serious assets over the ecosystem flyers. But you have to have conviction. You have to have conviction in Bitcoin. You have to have conviction in ETH, and you got to have conviction to hold on to these assets when the price is volatile and going back and forth. Now, I finally wanted to discuss one of the more risky positions. Now, we have not scaled into this one yet, but that is banker wrapped ETH. Now, we also were looking at a syrup wrapped ETH position that I have gotten out of. It was making good APR, but honestly, it was even more volatile on this, and I could keep a wider range. Now, banker is an extremely volatile asset, and we have a quite wide range on this one. Think around 40%. With a 40% range, we're earning around 162.39%. It's getting great admissions. We only have $4 in the position right now because we're just looking at it. But this one, when the market's down, I think this one's going to go a lot lower. And when it does, I may scale into this one because I am bullish on the banker bot on the base blockchain. And this would be a good way to earn some yield and accumulate some tokens. Let's talk about what I'm not doing right now. So, if you paid attention, the majority of my capital went into Bitcoin and USDC. I'm not scaling into tiny pools with these insane APRs. This is where the dashboard, even the one on Aerodrome, is misleading people because these numbers are inflated. And we'll take a look at DeFi Buddy in just a second, and you can take a look at some of these numbers. But is small, if a pool is small, it can work for experiments. But you got to have those giant core positions for size. Mixing them together is a great idea as long as you keep a larger amount of capital in the core positions. Now, what I'd like to do now is make this a little more practical. If you wanted a simple aerodrome framework, this is how I would do it. Before I even open the main pool page, I would ask myself, would I be okay with owning both of these assets for the next several weeks to months? If the answer is no, I'm not in. I'm out. My next step, I'm going to be asking myself, is this a core position, a major stable pool, or is this a correlated pool, kind of a mid system thing? Is this an ecosystem conviction pool, or is this a tactical emission farm, or is this a degen play like the banker wrapped ETH? You need to label it correctly and you need to manage that label correctly. A lot of mistakes just come from people expecting core behavior from degen pools. I was guilty of that myself, and I have been wrecked before. So I want to know, how many people are providing liquidity on Aerodrome? Are you providing to core pairs, the blue chips, Bitcoin, Ethereum, etc., or are you farming some random narrative token with a cool logo, maybe for a week, just to earn thousands of percent of APR? Just remember, one is way riskier than the other if you don't know what you're doing. Now, your next step is you got to check your pool structure and choose it. Are you going to use V1 or Slipstream? Because Slipstream is concentrated liquidity and you have to manage it a lot more, but you can earn some more yield. If you use the V1s, then it's a full range pool and you don't have to manage anything. You just earn yield. When you choose your range width based on reality and not your greed, and this is massively huge. If I was doing a tutorial for newer LP managers, I'm not telling them to go ultra tight ranges because they're not used to that. Those ultra tight ranges are going to eat them alive with impermanent loss, and they'll go out of range and they don't earn any fees. For a beginner, wider ranges or full range pools are much more forgiving in this space. Start off slow, not financial advice, of course. And because tight ranges are always displayed in the aggregators, they make the returns look amazing. They also are increasing your odds that you're going out of range and you're going to stop earning what you expect. Look, those wider ranges, they're not as sexy, but you'll be a lot safer and you'll have a lot less heartache. So remember, the final step is always test it first, always. Even if I like the pool, even if my thesis feels and looks great, even if the metrics look clean, test it because I truly want to see how it behaves with some of my capital there. And that is what you're seeing right before your eyes with this Aerodrome video series. So please consider liking and subscribing so you can stay up to date with all of the updates. So after we establish the positions, which I was showing you within my own dashboard, we have to keep an eye on fee generations, emission support, whether I'm in range, whether the volume's even durable, as the token thesis changes, how is there a risk of a hack? And most importantly, does the time being spent on this justify the result I may get? So remember, if you want real-time updates of DeFi or leverage trades, I post all of that in Telegram along with my market updates before I talk about it on YouTube. So if you want those real-time updates, check out our free Telegram group and check out dadsdefispace.org and sign up for our free email list and free DeFi course. Because remember, you're not doing this just because the APR looks nice. You're doing it because you believe in the assets, the position proved itself, and you did the research. So remember, liquidity is going to matter more than your own opinion, and narrative can bring attention, but liquidity determines the durability of the pool. And that's why I care a lot less about what people are talking about on social media, than about where that actual capital is sitting, who is voting for what, and where those emissions are going. Selective strength is not the same as a broad confirmation. A pool can look strong because it's being incentivized, and a token can look active because capital is showing up just at that moment. The route could even look healthy because people were farming an edge because they found out about it before you. But that's why I always ask, what if that narrative goes away? What's left? Excuse me. If the answer is real demand, real usage, and manageable structure, I might be interested. So honestly, if the answer is, well, APR used to be crazy, I'm out and I'm not going to check that one. I've been in wrong LPs before. I've chased that yield before, and I've looked at a number, convincing myself I was being strategic, but really I was just being greedy, adding extra steps and stress. But look, that's normal. We are humans and we are emotional. I've looked at a number, I've convinced myself that I was being strategic. No, I was being crazy. So the point is not to pretend you've never made mistakes. The point is to improve your process. And that's what I'm trying to do. And that's what I want you to do. I don't care about bragging rights. I care more about being able to repeat the process. I care less about the highest possible outcome. And I care more about what's durable, what is sustaining. Because remember, your processes matter more than your ego. And in LP management, egos get expensive quickly. So, what's your biggest mistake in DeFi so far? For most people, that answer actually teaches them more than what any APR screenshot's going to do. And let me know in the comments what yours was. And finally, if you didn't get anything else from this video, the best pool to scales are usually not the ones with the biggest APR number. They're going to be the ones with the best structure. And to figure that out, you got to do a little bit of research. The better the assets, the better the demand, the better liquidity, the more survivable that pool is going to be. So if you want real-time updates and of how I'm thinking through all these different setups, Telegram is where I do it. Check it out. Like the video if this helped. Comment below. Are you prioritizing core yield, ecosystem conviction of those secondary assets? Are you defensively positioning right now during the bear market? Let me know. And until next time, ladies and gentlemen, peace.